just like this pullback that we've seen, right? The mainstream media is all over it. And a lot of the things they said are valid. A lot of them are. It was overbought. It had gone up for 9 straight weeks. It had blown through moving averages. It was in need of a correction. They capitalize on all of that, and then they'll put a cap on it and say maybe it's topped and it's over, just like in 2011 and 1980 before that. But what they fail to mention, which invalidates all of it, is that, the snowball that was pushed down the hill to start this going happened in the access market when New York was closed.
In today's news recap, UBS silver price forecast, buy the dip opportunity, $55 target retained. The silver price in U.S. dollars ended the week at $48.66 per ounce, down 0.92% on Friday, but still modestly higher over the week after a volatile run that saw daily swings of more than 2%. Silver has pulled back from its record highs near $54.50 per ounce, yet UBS continues to view the correction as temporary and maintains its bullish target of $55 per ounce by mid-2026. UBS said the recent drop was driven by profit-taking from momentum-driven investors, not a change in the metal's outlook. The bank added that lower nominal and real interest rates, global debt concerns, USD debasement, and expectations for a global growth recovery in 2026 should drive silver prices higher. The bank expects the gold-silver ratio to narrow to around 76 times, with potential to reach 70 times, a move that would further support silver's relative strength. This backdrop should continue to support strong investment demand, UBS said, forecasting ETF holdings to surpass their all-time high of 1,021 million ounces, up from about 820 million ounces currently. Based on our gold price forecast of $4,200 per ounce and our view of the gold-silver ratio, we project a silver price of $55 per ounce by end June 2026, UBS said, calling the latest dip an opportunity to position for further upside. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Running a hedge fund or whatever, these people at the top level are being given the acknowledgement, the wink of the eye, if you will, by the same banks that have been suppressing the price. At the same time, we've talked at length about, and I started my first couple podcasts with you in 2020, we talked about the others that showed up on the Commitment of Traders report, which there was always just 2 groups of reportables, the largest positioning in the Commitment of Traders report published by the COMEX were the hedge funds and the commercial banks. Then all of a sudden there's this group called the others. Who are they? They are sovereign wealth funds. They're central bankers wearing a different hat. They're friends. They're an offshoot, if you will, or family offices of tremendous wealth started standing for delivery, which I'm like saying to you, Dunnigan, this never happens. What, less than 1% have stood for delivery my whole career. At this point, it's been 30 years I've been doing it. Something's not right. And now we see it. Of course, we've seen it with almost 40 central banks repatriating their gold from the Bank of England and the New York Federal Reserve. Early adoption into backwardation right now. We see problems of getting the metal. Sorry, there's a 8-week delivery delay, folks. We have a shortage of manpower and trucks in London, we were told. Or, not really a good example, but gets the point across. Venezuela says to Bank of England, can we please have our gold back? No, you can't. And when you see 40 countries pull their gold home from the Bank of England and New York Fed, they were there because for many years you had the Western rule of law and stable, liquid, efficient markets, the COMEX and the LBMA. They don't care. And you're seeing exchanges, the Shanghai Metals Exchange and their expansion in multi-jurisdictional expansion, one being built right now in Saudi Arabia, one just completed in Hong Kong, which allows you to take metal off of the exchange through Hong Kong and receive it directly by trading yuan into it. The people who are doing this are the central banks, and they are the most well-informed traders on the planet. That's number one. Now it's moving to the commercial banks who are telling their institutional size clients, early adoption is everything. And this is why most people fail at investing, because they move rather than trusting their intuition and listening to the rants of a guy like me. What the hell do I know? Or Alistair, what do we all know? Well, we've been right. And we have been right. By hook or crook, we've been right. And, you know, we were laughed at. And you look at an environment where Wall Street refuses to acknowledge it, but now they are at the highest level. But they don't tell you, yeah, we've been wrong. We laughed at all of you guys who wanted to buy gold and silver, yet it's outpaced the 10-year Treasury 2-to-1, doubled it. It's beaten the S&P 500 with dividends reinvested for 25 years, which, by the way, no one ever does. No one ever does reinvest all their dividends. But we are living in an environment of negative real rates, and you could argue yield suppression, where they're trying to keep the yield down best they can, monetization of assets. And this has pushed investors for a long time into risk assets, which have inflated valuations, like all the Mag 7. And it's hiding the risk. And that risk hiding, well, the insiders know. Why do you think they're leaving? As the public's chasing that FOMO. This isn't free market pricing at all. And the assumptions of return are off. You can't make these assumptions in this environment. And I think, to Alistair's point, the one thing about having gold and silver in your hand is it is an asset that has no counterparty liability. And if you do it before the masses figure it out, like the way the central banks started doing this 5 years ago, 6 years ago, 7 years ago, and then the others being the sovereign wealth funds and the commercial banks, these are people at the highest level. So yeah, I would say it's everything. And to Alistair's point of the ETFs being expensive, yeah, you're paying BlackRock and JP Morgan a 60 basis point management fee to, in essence, use your metal to drive the price down. There's an 81 million share short position in SLV right now. And what the hell is that? It's just, as Ed Steer says, it's grotesque. And it is. This drives the price down. It allows them to pull metal off elsewhere. But, you're paying them a 60 basis point management fee. You can store in one of our Brinks facilities for a fraction of that. Real stuff, which you can never take possession of SLV or GLD. It is expensive. But through all of this, and even this month where we've seen a big fallback of 10%, 58,639 contracts taken off. Multiply that times 100, you got 586,000 ounces of gold. No, 5,863,900 ounces of gold taken off the exchange, and multiply that times 4,000. So you're talking an awful lot of money worth of gold coming off just this month, but it's been that way every month since November. So what's the takeaway? Well, the takeaway is this. Starting in 2017 or 17, the central bank started buying and repatriating their gold. And then it proceeded to be the family offices, the hedge funds, the sovereign wealth funds. Now it's the commercial banks are telling us this. And at the same time, but that excluded the New York traders all this time, until November of this year. And now every month you're seeing deliveries like this of millions of ounces of gold and silver every single month, billions of dollars worth every single month. And again, using...
In today's news recap, China scraps gold tax break, sending shockwaves through global bullion market. China has abolished a long-standing tax incentive on gold sales in a move that could raise costs for consumers in one of the world's largest bullion markets. Effective today, the Ministry of Finance announced that retailers will no longer be allowed to offset a value-added tax, VAT, when selling gold purchased from the Shanghai Gold Exchange. Bloomberg reported. The new rule applies whether the gold is sold directly or processed into other forms, covering investment products like high-purity bars and coins, as well as jewelry and industrial materials. While the change is expected to boost government revenue at a time when weak economic growth has strained public finances, analysts warn it will likely increase the cost of buying gold for Chinese consumers. The policy shift comes amid a period of high global demand for the precious metal. Despite the correction, gold remains near the $4,000 an ounce level, and some industry players still expect prices to reach around $5,000 within a year. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
When you have a Federal Reserve that has missed their target inflation rate for 55 straight months or thereabouts, of 2%. In fact, missed it by 50%. They call that tepid. I don't know how missing your rate by 50% is tepid. It seems kind of way off base to me. But there's a lie, of course, about what inflation really is. It should be called the CP lie and the BS, not the BLS. And we know that. We've talked at length. John Williams says inflation's 11%. Shadowstats.com, not 3%. So nominal returns, to Alistair's point, are an illusion when inflation certainly is higher than we think. But, even at 3%, and they're trying to push rates down below that, but even say you get a 5% return, right now you're losing in real terms by John Williams' measurement a negative 6% real return. And in that environment where you, to Alistair's point, have record participation by the public in the equity market, record amount not only of margin debt over $1 trillion, but also record speculation and leverage with options. Bonds are very vulnerable, and equity valuations are very distorted. So earnings may rise, but real purchasing power is falling. But the real trouble, to Alistair's points, in the bond market, and that's why when you see the chief investment officer of Morgan Stanley come out and say, well, the 60-40 rule that we've used, 60 stock, 40 bonds for 50 years. Now remember, and since 1982, when the interest rates have fallen straight down at a 45-degree angle, if you're 60 stock, 40 bonds, you'll retire wealthy, period. That's not really the case anymore. And so as the chief investment officer of a large commercial bank who has never acquiesced to anything more than a pittance of gold in your portfolio, he says, sell half your bonds and buy 20% gold, 60-20-20. You got Michael Hartnett, the chief analyst at Bank of America, says, no, shouldn't be that either. It should be 25, 25, 25, 25. Stock, bond, short-term treasuries, gold. You have Jeffrey Gundlach, the bond king. He's the head of bonds for BlackRock, says, 25% allocation to gold is not overweight. This is a guy that's made his living selling bonds, the antithesis of gold. And you have all of these institutional level advisors and chief investment officers saying, you need to own some gold right now. And in all three cases, it's at the expense of the bond portfolio. You didn't hear them say trim your 60% stock portfolio. So right now I think there is no question that the world is beginning to understand that not only is the Fed trapped, raising rates blows things up like the bond market and all of the institutions that hold their wealth in treasuries like the banks and the insurance companies and the real estate market. And we're already looking at a Fed, they're projected here to lower rates into an environment where they're missing their target by 50%. That's acquiescence. We're going to give up in essence our mandate without really acknowledging it to inflation target of 2%. And by the way, it's funny, as a side note, just for those people who haven't heard, I asked Judy Shelton, I said, Judy, why the hell did they ever come up with this stupid 2% rate anyway? Shouldn't it just be zero, flat prices? Wouldn't that make standard of living better? She says, it was Janet Yellen's husband who came up with it actually, and he said, if you do that, you can't give your employees raises because it'll come from the bottom line if everything is stable. But if you have a 2% inflation target and give your employees a 1% raise, they feel like they're getting ahead even though they're falling behind. And that's really what's happening here. We're all falling behind in the face of a dollar that is losing value precipitously. Last thing I will say is that when we look at the value of the dollar in terms of purchasing power, which is important because that's really what it is. Alistair says you might get your money back, but what's it going to be worth? We're misled by measuring it against the Dixie, the other crap currencies that are all losing value. And the dollar was down 11% against these crap currencies. It's rallied back to 7 or 8%. Okay, but let's measure it against gold. It's down 50%. Against silver, 60. How about last year? Same thing. When you measure, if you go back to 1971, James Rickards would say gold should be $94,000 right now, measured against gold. When you measure the dollar against a basket of worthless currencies, it's masked. So everything that we are doing is stacked against us in measuring against a basket of worthless currencies, measured against gold, and everything is falling in price. And I think the asset managers must understand that even the best laid plans, those that have worked for 50 years wonderfully in an environment of dollar supremacy, in trust of the institutions of this country and of the bond market that has been weaponized and sanctioned, those things aren't the same anymore when that environment changes.
What do you think of Schectman's take? Do you agree that a massive gold and silver squeeze could happen in December? Is he just talking his book? Will gold and silver top very soon? Post in the comment section down below your honest opinion. Hype the video if you liked it. And make sure to watch this one right here because it's a perfect fit for you. And I'll see you on the other side.